In this video, we are going to talk about the top 12 best real estate investment trusts, also known as REITs, to buy before or during a recession. So before starting, please like this video and subscribe to this channel for future updates. Let's get started. In the United States, anxiety about a recession is at an all-time high. The Consumer Price Index readings for June over the same period came in scorching hot at 9.1%, exceeding consensus expectations on Wall Street of 8.8%. The 2-year Treasury bond and 10-year Treasury bond yield curve inversion steepened. Since the yield curve inversions that preceded the recessions of 2001, 2008, and 2020, economists frequently interpret them as indicators of impending recessions. Real estate investment trusts, or REITs, are a good option for investors looking for tangible assets that might outperform stocks and bonds. REITs frequently offer high distribution yields, which can protect portfolios during bear or sideways markets. Here are 12 of the best REITs to buy in the event of a recession. Number 12. Alexandria Real Estate Equities, ticker, ARE. Alexandria Real Estate Equities specializes in research-oriented properties that are leased to life science, ag tech and technology tenants. The REIT counts major pharmaceutical companies such as Bristol Myers Squibb, Moderna, Eli Lilly and Sanofi among its tenants. Its life science focus has enabled the REIT to participate in pharmaceutical industry growth and deliver attractive 15% average annual growth over the past decade. Thanks to a robust leasing environment, Alexandria Real Estate Equities was able to grow revenues 28% and net operating income 25% during March 2022. With 99.9% fixed rate debt and a credit ranking within the top 10% of the REIT industry, Alexandria is well positioned for rising interest rates, and the REIT has no major debt maturities before 2025. Alexandria Real Estate Equities' shares have earned buy or strong buy ratings from all 11 of its covering Wall Street analysts. Bulls cite life science market tailwinds and the REIT's portfolio of investment-grade tenants as reasons to invest. Alexandria Real Estate's history of dividend growth is impressive too. The REIT has delivered 12 consecutive years of dividend growth, including averaging 7% annual gains over the past 5 years. Number 11. National Retail Properties, ticker, NNN. National Retail Properties is one of the best REITs for income investors, delivering 32 consecutive years of dividend increases. This mature triple net lease focuses on smaller properties primarily in the eastern half of the U.S. At present, the REIT owns 3,271 properties spread across 48 states and representing 33.5 million square feet of leasable space. The portfolio has an average weighted lease term of 10.6 years and 99.2% occupancy. National Retail Properties has more than 370 tenants. Its largest retail sectors are convenience stores, automotive services and fast food restaurants. Multi-location tenants include 7-Eleven, Circle K, Goodyear, Wendy's, Taco Bell and Dave & Buster's. The REIT has plenty of powder for additional acquisitions. In March 2022, the balance sheet showed $53.7 million of cash, no amounts drawn on its $1.1 billion bank line of credit and no material debt maturities before 2024. National Retail Properties stock has been hit with broad market headwinds in 2022, down 17.6% year to date. Still, the consensus estimate among the 14 analysts covering the REIT that are tracked by S&P Global Market Intelligence is buy. Plus, shares are attractively valued at the moment, trading at a low 13 times forward funds for operation, which is more than 8% below the REIT sector median. Number 10. Agree Realty, ticker, ADC. Agree Realty, ADC, is a triple net lease REIT that mainly serves e-commerce and recession-resistant tenants. Roughly 86% of the REIT space is leased to national retailers and 68% of its tenants enjoy investment-grade credit ratings. Tenants are drawn from recession-resistant retail sectors such as grocery, pharmacy, home improvement, tire and auto service and convenience stores. They include well-known names like Walmart, Kroger, Lowe's, Tractor Supply and Dollar General, among others. Triple net leases make the tenant responsible for real estate taxes, insurance and property maintenance costs and are generally considered less risky than other lease types. Agree Realty has grown dividends 5.5% annually, on average, over the past decade. The latest increase was 7.8% in April and the company became a monthly dividend payer in 2021. The payout ratio stands at a conservative 70% of core funds for operation. Another reason ADC is one of the best REITs for the rest of 2022 and beyond. The company's credit rating was recently upgraded by Moody's to Baa1, with the agency recognizing Agree's low leverage and resilient portfolio. Morgan Stanley analyst Ronald Camden recently initiated coverage of ADC shares with an overweight rating, the equivalent of buy. He likes the company's defensive characteristics and growth opportunities. Bank of America analyst Joshua Dennerlein upgraded the stock to buy in June 2022, citing defensive characteristics that should enable the real estate stock to outperform during a recession. Number 9. Digital Realty Trust, ticker, DLR. Digital Realty Trust, DLR, is a leading data center REIT that owns 291 facilities representing 35.8 million square feet of space across 25 countries. DLR mainly serves cloud providers, IT companies and mobile telecoms and counts Meta Platforms, AT&T, IBM, Oracle, LinkedIn and Verizon among its customers. Demand for data storage and processing is fueled by a fast-growing digital economy and tailwinds tied to new technologies like 5G, Internet of Things, autonomous vehicles and artificial intelligence, AI. This REIT has produced 12 straight years of quarterly revenue growth on an annualized basis. Revenues rose 3% year-over-year during the March quarter and Digital Realty Trust achieved record bookings. The REIT's fund for operations per share grew by a respectable 6.7%. In June 2022, Bank of America included DLR on its list of top alpha surprise stocks, which calculates potential upside based on dividend discount and earnings surprise model. Citi also recently recommended DLR shares on its list of quality growth stocks to buy during equity market pullbacks. Number 8. Rexford Industrial Realty, ticker, REXR. Rexford Industrial Realty is a fast-growing industrial warehouse REIT. REXR could be one of the best REITs for the remainder of 2022 amid continued supply chain challenges. Rexford controls over 60% of the REIT-owned industrial real estate near the ports of Los Angeles and Long Beach. The company operates strictly in Southern California, an enormous $31.6 billion industrial market that is estimated to be as large as the next 5 largest U.S. industrial markets combined. The REIT has averaged annual growth of 14% for FFO, funds from operations, a REIT earnings metric, per share and 18% in dividends over the past 5 years. Rexford increased its 2022 guidance, looking for 13% core FFO per share gains this year at the midpoint of guidance, up from its previous outlook for 9% growth. And earlier this year, the REIT rewarded investors with a rich 31% dividend hike. Rexford Industrial Realty shares are rated buy or strong buy by all 8 covering Wall Street analysts. Bank of America Global Research strategists made Rexford one of their top 10 picks for 2022. Number 7. Capital Management Annaly Incorporated, ticker, NLY. Capital Management Annaly is a REIT that appears to be trading at a discount with a trailing 12-month price-earnings ratio of just 3.6. REITs have a PE ratio that is 27.5 on average. The agency segment of NLY, which mainly deals in mortgage-backed securities, accounts for the majority of the company's total book of business. NLY is anticipated to release financial results for the 3 months ended on July 2022 following the market close. The consensus revenue estimate is $1.53 billion, and the consensus earnings per share estimate is 97 cents. Right now, NLY's distribution payout of 88 cents per share per year is noteworthy. Capital Management Annaly dividend yield is 13.9%. Number 6. New Residential Investment Corporation, ticker, NRZ. New Residential Investment is another REIT that looks to be trading in value territory with a trailing PE ratio of 4.45. This REIT primarily deals in mortgage-related assets, with segments operating in origination, servicing, residential securities, properties and loans, consumer loans, and mortgage loan receivables. Recently, NRZ said it would be operating as an internally managed REIT, which management estimated would produce $60 million to $65 million in cost savings annually. Along with this change comes a rebranding of the company's name to Rhythm Capital, and a new ticker, REITM. The change is slated to occur on or about August 2022. NRZ last paid an annualized distribution of $1 per share. The company's dividend yield is 10%. Number 5. Sun Communities Incorporated, ticker, SUI. Unlike most REITs, SUI doesn't operate a traditional portfolio of commercial, residential or even industrial properties. Instead, SUI acts as an owner and operator of manufactured housing communities, which encompasses recreational vehicles and marina resorts. Currently, the company's portfolio consists of roughly 283 housing communities, 192 RV parks, 130 marinas, and 41 RV holiday sites across the US, UK and Canada. Over the years, SUI has enjoyed strong growth through its spree of property acquisitions and a development pipeline that targets multiple new projects every year. Year-over-year quarterly revenue growth currently stands at 23.8%, with the company recording trailing 12-month revenue per share of $20.54. SUI dividend yield is 2.2%. Number 4. American Tower Corporation, ticker, AMT. As an industrial REIT, AMT manages a portfolio of properties primarily housing the cellular towers critical to wireless communications networks. Currently, AMT operates over 220,000 cell tower sites globally across the US, Central and South America, and India. The REIT has benefited strongly from tailwinds stemming from the 5G boom in recent years. Year-over-year quarterly earnings and revenue growth for AMT stand at 10.3% and 23.2%, respectively, which is highly impressive for the REIT industry. Investors will like AMT for its low beta, or relatively low risk profile. With a beta of 0.46, AMT is less than half as volatile as the S&P 500 index. AMT last paid an annualized distribution of $5.53 per share. American Tower Corp's dividend yield is 2.2%. Number 3. Boston Properties Incorporated, ticker, BXP. BXP is a more traditional REIT, managing a portfolio of 200 Class A office properties in Boston, New York, San Francisco, and Washington. Class A office properties are the most prestigious buildings in an area, commanding significant size and able to charge above average rents. Think of the latest high-rises, with advanced elevators, HVAC and state-of-the-art technological capabilities. These properties are often leased by high-profile tenants like tech companies, investment banks and asset management firms who have to impress employees and clients alike. Despite the growing preference for remote work, BXP still recorded strong year-on-year quarterly revenue and earnings growth of 6.7% and 42.2%, respectively. BXP last paid an annualized distribution of $3.92 per share. Boston Properties' dividend yield is 4.4%. Number 2. Prologis Incorporated, ticker, PLD. Investors looking to play both the REIT sector and the supply chain industry can buy shares of PLD. As a global logistics REIT, PLD is one of the biggest owners of industrial property worldwide, with over 4,675 holdings totaling over 1 billion square feet of leased space. Over the last decade, PLD has derived strong growth from the surge in e-commerce as a supplier of warehouse and distribution center space. The tailwind and strong demand for e-commerce and third-party logistics providers have fueled PLD's low vacancy rate and ability to increase rents for its tenants. The last payout was an annualized $2.84 per share. Prologis's dividend yield is 2.3%. Number 1. Ventas Incorporated, ticker, VTR. Like PLD, Ventas also combines the benefit of owning REITs with exposure to another stock market sector. In this case, it's healthcare, as VRT owns and operates a portfolio of 1,200 senior housing and healthcare properties, which the REIT either leases to tenants or operates via independent third-party managers. An aging U.S. population, along with growing senior healthcare needs, is likely to drive further demand for healthcare space and thus VTR's portfolio of properties. Although the pandemic severely affected senior and assisted living housing, VTR's occupancy had recovered to an average of 83% by the end of the first quarter of 2022, with its balance sheet stabilizing significantly. VRT last paid an annualized dividend of $1.80 per share. VRT's dividend yield is 3.5%. Which of these REITs do you think are good buys before or during a recession? Let us know in the comment box below. Please like this video and subscribe to this channel for the best stocks to buy, investing strategies and much more. Thank you for watching.